Bank of Canada says a major shift in U.S. trade policy and the unpredictability of tariffs casting a pervasive uncertainty over the Canadian economy, making it difficult to forecast the chances of a recession and the future path of inflation. Joining us now to break down the decision, what it means for interest rates, is Andrew Kelvin, head of Canadian and Global Rate Strategy with TD Securities. Great to have you on today, Andrew.
Always a pleasure. Thanks for having me.
We got a lot of meat on this bone when it comes to a statement from a central bank. No action in terms of changing their trend-setting policy rate, but lots of uncertainty, lots of scenarios. Your first reaction to this when you saw it today?
I mean, it was a very interesting meeting. And even heading into it is very interesting because unusually private sector forecasters were quite divided on the likely outcome. And even in the press conference afterwards, it was either Governor Macklem or the senior deputy governor did note that they had considered a cut. So it was a tight meeting. I think the Bank of Canada really laid out their path for how they would think about monetary policy in a speech last month, in which Governor Macklem conceded that there was an awful lot of uncertainty. Since then, we've kind of flipped the tariff switch on and off a few times. Because there's so much uncertainty, the Bank of Canada couldn't afford to put all their eggs in a forward-looking basket. Because a lot of times when a central bank conducts monetary policy, they'll have their forecast, and they'll think to themselves, right, what is the optimal monetary policy for that forecast? Because their tools don't work in real time. You can't cut or hike rates today and impact prices tomorrow. It takes 6 or 8 quarters. So they'll tailor the monetary policy to what they think the most likely outcome of the world will be. Today, that's difficult in the best of circumstances. Today is an extremely difficult environment. So what Governor Macklem conceded was that with all the uncertainty, they can't afford to be that forward-looking. They need to be a bit more humble about their ability to predict the future in this sort of environment. So they'll have to be a little bit more backward-looking. And given the sort of lagged nature in Canadian data, given that core inflation is still closer to 3% than 2%, they just didn't have enough data in hand to justify a rate cut in that sort of a world. But what made it so, I will say confusing, that's maybe too strong a word, but certainly I think some people can be forgiven if this is their reaction.
There was no rosy picture laid out.
There absolutely was not. If you had given me that communique ahead of time and not told me what the outcome was, I would have been like, oh, I guess they decided to cut after all. That would have been probably my inference. So, because they laid out, and even their monetary policy report. So it was a monetary policy report meeting. They do 4 per year in which they update their forecast. And usually that's a fairly straightforward thing. Growth was a little stronger than we thought. Maybe there was a fiscal package, and you adjust things up and down. This time they actually came up with 2 fully articulated different scenarios, one of which involved, let's call it a contained trade dispute, and one of which contained a much larger trade dispute. And they, I think, very rightly noted that it was very difficult to determine analytically between the 2 scenarios or any other number of potential scenarios out there. Because we can incrementally change what the world looks like in any different number of ways and create infinite number of scenarios. So the 2 still, I think, were pretty good as illustrative versions of what the world that could be. They were both worse than the one that they were expecting in January.
Yeah, there was not good and then really not good.
Precisely. Yeah. And one of my colleagues remarked to me that it's sort of strange that you had too much uncertainty to really have a forecast, but you also decided that you need to keep rates on hold. Because certainly at the end, Bank of Canada feels like they don't have plenty of uncertainty. And if there's one thing central banks are known for, and economists are known for in general, it's trying to cut through uncertainty to produce highly precise forecasts. If the Bank of Canada feels like they can't put a forecast together, if they can't put a base case together, how's a household supposed to do it? How's a business supposed to do it? Our view, like the TD Securities view here, is that the fact that Bank of Canada held today, and we were expecting them to hold, that was more a reflection of the fact that they told us last month that they were likely to hold at this meeting. We still think rate cuts are coming, because at the end of the day, as you note, it was not good and really not good. These are the 2 most likely outcomes in their view, and both of those probably require some degree of monetary policy accommodation.
There was a line, too, from Tiff Macklem where he talked about the fact that they are ready to act decisively on information that can change very quickly. It made me think about the possibility of emergency action. Do you think they're at that stage yet where they'd have to break from their meeting cycle to give us something on rates?
So Governor Macklem was asked about that. his his exact phrasing. I'm going to paraphrase a little bit because I don't trust myself enough to get it perfectly right. I don't want to be accused of misquoting
memory,
him.
yeah.
It's we're doing this in good faith here. He said something effective that I wouldn't get over-rotated on the word decisive. And essentially what he's trying to make clear is their commitment to price stability is absolute. They will take action. It wasn't meant as in his words, it wasn't meant as a signal that they might do a jumbo cut down the road or they might have to move intermediate. Having said that, if you're not going to act in a forward-looking fashion, when you have a forward-looking instrument, because again, their instrument works in the future, not in the present. If you're going to be backward-looking in your monetary policy, you are implicitly falling behind the curve here. And when you fall behind the curve, in either direction, what that can bring about is sometimes larger policy moves, both up and down. And we saw them in the aftermath of COVID.
I went back and looked at those statements from March of 2020 and those oversized rate cuts out of meeting rate cuts to see what the tone was around that. Yeah.
And after, when they actually started lifting rates, there was some 50s and 100s in there too because they fell behind the curve. So I think this sort of monetary policy stance, it does raise the risk of them having to move in larger than 25 basis point increments. In terms of the intermediate cuts, if it's appropriate, they'll do it. I think this is something that needs to be made clear because people will always ask the Bank of Canada, and it puts them in a bind. Because someone will say, if necessary, are you prepared to cut 50? And they don't want to say, yes, if necessary. But the answer is, they will do whatever they feel is necessary. And if the global economy were to go into a very quick and sudden tailspin, yes, intermediate would be on the table, as it was heading into the COVID pandemic. I don't think we're anywhere close to that. There's nothing I've seen in economic or financial market data to suggest that intermediate cuts are happening. I am a little bit more on guard around a potential 50 basis point move at a scheduled meeting. But I should stress our base case here is for 3 25 basis point moves.
The other, the word uncertainty, I don't think people do those word clouds anymore, but it probably showed up a lot through the statement. We really underscored, there was a part of, I think, of Governor Macklem's opening statement where he said, the two scenarios, first one, and then the second one is the worst scenario in terms of prolonged recession. On April 2nd, reciprocal tariffs announced, they thought now we're in scenario 2. And then you get a 90-day reprieve and a lower baseline of 10%. And now we're halfway between scenario 1 and 2. To me, that just spoke about the fact that this is moment by moment. I think the exact quote here, because I highlighted it, we don't know what's coming next.
Yeah, and that's a perfectly fair statement from the central bank. I'd say their scenario 1 is probably a little bit stronger than our base case scenario would be for the Canadian economy. Their scenario 2 is much worse than our base case scenario. It was encouraging to me. Encouraging is the wrong word. I was somewhat relieved after April 2nd when the state of play for Canadian exporters did not change after April 2nd. The auto tariffs came into effect, but the USMCA exemptions were projected to continue through this reciprocal tariff regime, however long that lasts. Now, these things can change quickly. They have been changing quickly. I feel like Canada and Mexico are maybe a little bit ahead of the curve here because we have been dealing with this uncertainty since the start of 2025, whereas the rest of the world, it's welcome to the party, guys. Yeah. It's a lot of fun. We haven't seen deterioration in the Canadian specific measures. The secondary effects are still material though, because if you're someone who produces a commodity that's traded on the global market, your prices have moved. We've seen energy prices fall, and if you fall into a very deep global GDP recession, energy prices will move lower. It will impact broader commodity prices. So even if Canada is not directly targeted with future U.S. trade actions, we are still part of the world. We are still part of the world economy, and anything that hits U.S. demand in the future or global demand in the future, broadly speaking, will have second-round impacts into Canada.